Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
For our Bloomberg television and radio audiences worldwide, I'm David Westin. We'll welcome now Mary Barra. She is the General Motors Chair and CEO. So, Mary, you are the woman of the hour, I must say, whether you like it or not. Let me ask the question I think on everyone's mind. What comes next? We know there's individual plans that have been struck at all three of the big automakers in Detroit. How far away are we from layoffs as other plants really run out of the parts?
Well, David, first I want to say I'm extremely disappointed and frustrated that we're even on a strike. We didn't need to get here. General Motors has an exceptionally strong offer on the table. It's historic. It's the largest increase from a wages perspective in our 115-year history, along with world-class health care benefits and many other provisions, job security, et cetera, and a COLA adjustment. So when you look at the strength of the agreement we have on the table, we really don't need to be here. Yes, they have one plant down right now, and it'll impact three very important products. Two brand new, our Chevrolet Colorado and our GMC Canyon, both mid-size pickups that are in strong demand, as well as our Chevrolet cargo van that does exceptionally well in the market. So this is having an impact, and we'll have to see where they go next. I will say we're ready for this. As we've dealt with COVID and dealt with the semiconductor shortage, as well as other supply chain challenges that have continued to persist from COVID. Our team knows how to manage these situations. They're staying agile, and we're going to do what's right for the company. We're going to make sure everyone stays safe. But this is a strike that didn't need to happen.
Mary, as you say, you've made an offer already for a rather substantial increase in wages. It's not what the UAW wants. Implicitly, you've agreed that they do need and deserve some increase in wages. But is this about more than that? Is this existential in a sense for the auto companies in terms of your need to move into electric vehicles, and from the UAW's point of view, that they believe that, in fact, moving to EVs will actually cut the workforce by as much as 40%?
Well, you're absolutely right. This is a once-in-a-century transformation we're in the middle of moving from internal combustion engine vehicles to electric vehicles. And at GM, we're at a very pivotal point because we have so many electric vehicles ready to launch, in the process of launching. And this is important to securing all of our futures. We need to get these vehicles out. They're wonderful vehicles. We've got waiting lists for most of them, or orders already in place. So it's important that we meet that demand. And one thing from a General Motors perspective, from job security, we have jobs for all of our people as we make this transformation. More than 2 years ago, we started planning for this. And one of the reasons General Motors invested in doing our own power units, which is a component that's very important on an electric vehicle, we designed them internally, and we are now allocating that production to the plants that build internal combustion vehicle engines right now. So we have worked very carefully to have a job for everyone so we can make this transformation together. And frankly, when you put have a strike and we're not making vehicles, you start to put that at risk. So it's a historic transformation. We need to make sure we can compete, and we need the company to be profitable because those profits get invested in new products that, again, it's a circle of when we invest in a new product, there's demand for that product from consumers that provides the jobs because we're building those vehicles in our plants. We need to invest in our future, and we have a plan to take all of our employees along. I think this is very important. So that concern there's not a place for them is not true at General Motors.
If, Mary, you were to find it in your heart to come close to what they demand, to accept it, what would it mean for the future of General Motors? You've just come out of bankruptcy 15 years ago, as I recall.
I think that's a very important point, because if we can't invest in new vehicles, which we need to be profitable to do that, then we're not going to have a strong future. And David, you know extremely well, this is a very competitive industry. There's new entrants that are not represented by the UAW that already had a lower, wage structure. So we need to compete. I'm really proud of our manufacturing team. The way they managed through COVID, the way that they have worked and been very agile as we've dealt with all the supply chain shortages, and the fact that for the last 2 years, between our engineering and our manufacturing teams, they've delivered world-class quality as recognized by J.D. Powers. We have a strong team. We want to do everything in our power to win the future, secure their future, and lead for the next 115 years. We need to be able to do that.
Mary, are the negotiating teams meeting today, to the best of your knowledge? And by the way, are you participating directly in any way?
I have been participating. I've been involved since before July 18th when the talks kicked off. I've been on call more than once a day, calls, texts, meetings, and I have been at the main table myself over the last few days. I'll continue to be extremely involved. Our team's ready. They're there waiting to negotiate. So, my request is the UAW leadership needs to get back to the table so we can get these problems solved, get our people back to work. I think another important point is for every job that General Motors has, there's 6 more jobs in the economy that depend on us running. So this is broader than just General Motors. This is important for the plant cities especially, but really for the nation.
Yeah, we talk about 150,000, potentially it's a lot more than that, to your point there. Lastly, Mary, I'm mindful of the fact that your father was a tool and die maker at Pontiac, when my father was a tool and die maker at AC Sparkplug, just some 30 miles apart. You and I, as young people, have gone through UAW strikes, different from this one, but we've gone through them. What do you think our fathers, if they were with us today, what do you think they'd say to each other about what we're seeing right now?
Well, I think my father would say, as he looked at the historic deal that we put on the table, that the company is committed and wants to recognize our employees for their hard work and wants to make sure they have a secure future. So I think he would look at this offer, and if it was on the table for him to vote, he'd vote yes.
Okay, Mary, thank you so much for your time. As I say, on a very, very busy day for you. I really appreciate it. That's Mary Barra. She's General Motors Chair and CEO.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
All right, and our Geetha Ranganathan, she covers all the media stocks, which means she covers Disney, which means she's going down to their investor day, so she'll be all over the place, I'm sure. Hey, Geetha, there's going to be a lot to talk about at Disney here. Are they really going to sell the ABC television network?
Definitely seems like it, Paul. I mean, Bob Iger just a few weeks ago, of course, at that Sun Valley conference said that, they're not married to the linear TV network business. It's not core to Disney anymore. I mean, that's so ironic considering, they bought ABC for that. It was that huge deal back in 1995 for $19 billion. I mean, so much of, Disney's reputation has, kind of been tied to its TV network. So it's strange, but I think what it really tells us is that they see the writing on the wall and they think that the pay TV universe is probably going to implode sooner than the rest of us think.
All right, so who could buy it and what's it worth?
Okay, so there are a lot of rumors and a lot of press reports right now circulating. So there has been some talk about Disney exploring a sale of ABC networks and the owned and operated stations. They have about 8 stations in top 10 markets with Nexstar, which is the largest TV broadcaster right now in the U.S. So, Nexstar has said that they're very interested in the ABC assets. They should be able to acquire most of them without too much friction, meaning there is an FCC ownership cap of about 39% for broadcast stations. But Nexstar, because it already has a presence in most of these stations with their CW network, thinks that it should be able to get the deal done. That said, I mean, I think they still will have to,
and they have the money.
Swap some. So that is a little bit of a question mark.
Yep.
So we think that the ABC stations are actually worth upwards of stations as well as the network are worth upwards of $4 billion. That's applying a pretty conservative 7x EBITDA multiple. Now, Byron Allen, who is like this really prolific media mogul, has put in a bid which apparently values those networks at about 8x EBITDA, which means that the ABC property would be worth $5 billion. And obviously Disney wants to get the most for it. The problem with most of these acquirers or the parties that are interested in possibly acquiring ABC is that they're all highly levered themselves. So most broadcasters, so even an Nexstar, for instance, currently has about $7 billion in debt. Allen Media obviously has a lot in debt. So we'll have to see how they kind of get the deal done.
So, Geetha, I guess that calls into question. It's one thing to sell a declining broadcast network and some TV stations. I think most people would agree that, all right, the time of that business is probably past, and it's all about streaming. The bigger question, I think, for a lot of investors, and you'll probably talk about it next week when you're down visiting the Walt Disney folks, is ESPN. What do they do with ESPN? What do you think they will do? What should they do?
So ESPN, I actually think they definitely want to keep the asset. Now, remember, they are going to be breaking out the financials for ESPN in a few quarters. That is what they've promised. It's going to, kind of be its own segment. And that's the first time that they're doing that in Disney's history. So they obviously want to clean up house before they do that. And we've seen a lot of, cost cutting. We've seen a lot of these new deals. They had that deal with, Penn National. And most recently, and I think this is really transformative for the entire pay TV universe, is the deal that they inked with Charter. This is the first time in the history of the pay TV media ecosystem that a content company is actually offering access to its streaming services, okay, and for kind of either a wholesale rate or even for free in certain cases. But the more important part is that they're actually going to offer access to the flagship ESPN streaming product when it goes out in full force, which probably will be sometime in 2025, 2026. We don't know. But they're definitely preparing for that future. That's what it looks like. So I don't really think that they want to kind of get rid of this asset. Maybe they really want to clean it up. Maybe they want to spin it out. But I still think they want to keep control of it.
I wonder if this is like, Paul, the kind of shift that you saw when radio used to be it. Radio used to be the thing for listeners and for advertisers, and that all went away, and it's probably a completely uninteresting business for most people. They went to TV, right? Is this linear TV going through that same transition, that same death? And then is streaming the new TV?
Yeah, I mean it was, we went from broadcast television when you had 3 networks and then 4 with Fox. And then cable TV came along, and that totally redefined what we watch, how we watch it, and it really made it so much more competitive. We got so much more product. Now you're even taking that to the next stage. And I guess, Geetha, that brings us to the question, if all the big media companies that you follow, the Paramounts of the world, the Warner Brothers, the Discoveries, when you talk to investors, do they believe that this transformation can actually work and they can make money on it, or does nobody want to talk to you anymore?
A little bit of both. But I think the one thing, for any investor who had questions about whether streaming is a good business, I think we have our answer, right? Because we've seen Netflix kind of turn things around. They are actually expected to generate about $7 billion in EBITDA this year, approximately 20% margins. And the idea is that as they kind of gain subscribers and as they lower costs, they're able to kind of spread those costs over a wider base, eventually getting to, a 25 to 30% margin, which then kind of makes you agnostic because in its heyday, TV networks were generating about 35% margins. So yes, streaming may not be better than the TV network business, but it could potentially be as good as, again, that we're talking about Netflix, which is obviously the industry leader. It is going to be a much harder road for all these smaller companies, whether it's a Paramount or Warner Brothers Discovery, but they are kind of doing a lot in terms of content cost rationalization. Again, Paul, we've spoken about this many times, and I know you think too that there will be a streaming shakeout at some point. There will be consolidation. So all that is going to play out, I think, over the next 18 to 24 months. But yeah, I think we will be, we'll land up with maybe 3-4 major streaming players who should be all profitable, hopefully.
All right, now we've got some, in addition to all of that, if that wasn't enough for the industry and for investors, there's also this thing of strikes. We've got writers on strikes. We've got actors on strikes. What's the impact on media, on the companies, on what you and I and other consumers will be able to see on our TV screens and in theaters?
Yeah, so definitely we're seeing some, small effects of that right now. Nothing really major in terms of disruption of schedules, but, as we kind of get deeper into like the film slate for 2023 and even 2024, that's when we're really going to start having some problems. We've already seen some film delays. Dune 2, for instance, from Warner Brothers has already moved to 2024 because they're not able to market the film. They're not able to do promotions. So that's, a lot of film studios are kind of running into that problem. In fact, from a financial aspect, though, what we're seeing is that most of these companies have actually raised their free cash flow guidance through the rest of the year. They've raised their free cash flow guidance, but they've lowered their EBITDA guidance because the lack of fresh programming is definitely going to have an impact on, advertising sales. And that's what they've all said. They've all said, expect double-digit ad declines because you're not going to have any fresh programming. We really have nothing to go to advertisers with. I think it really becomes a problem in 2024 if they're not able to resolve the strikes, if people are not going to get back to work and produce new content. We're going to have a real headache in 2024.
All right, Geetha, thanks so much for joining us. As always, Geetha's the expert. Geetha Ranganathan, she covers all the media industry.
And she's going to the park.
And she's going down to Disney.
On Monday for the investor. I was thinking, because Tucker asked when the last time I was there was, and I remember that the Coury Hart album, Boy in a Box, had just come out. I bought the cassette for my Walkman, and so I believe it was spring break of 1986.
Spring break.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, we talked about one of my favorite asset classes with Joe Misek and munis. Another one of my all-time faves, really since the last 10 years, has been this private credit game.
I love it, too.
I love it, man. And we had this person in a day or two ago. She's more on the syndicated loan side, and I was saying, how much competitors are these guys to you? And she says, they're big. They're big, and they're getting bigger. Randy Schwimmer, co-head of Senior Lending and Senior Managing Director, Churchill Asset Management, joins us. Randy, talk to us about your business, the private credit business. How's it been this year? Are there deals? Because it seems slow, but I don't know in your market. What are you seeing?
So last time I was here, I promised you guys some good news in September, right? Yeah. So post Labor Day, we always wait for the post Labor Day rush. Well, I'm here to report that we have a post Labor Day rush.
Okay.
So let's talk with the public markets right now. So high yield bond market, which was kind of, not very active all year. Rates are very high, issuance low. They had an $11 billion week last week, okay? That's the largest issuance in 2 years. So that's good. So that's waking up. The liquid loan market, which you talked about, broadly syndicated loans, $20 billion so far in September, first 2 weeks. That's more than any full month all year long. So we're starting to see some activity in the public side. Why? Because things are starting to heal. The economy is better. Inflation's under control. The other thing that's going on now is as a result, the larger buyouts are starting to come to the market. We haven't seen any of those mega deals this year, going back once the Fed started raising rates. So we now have the 9th largest deal ever since the Great Recession, a company called WorldPay.
Yeah, that's what this other guest was talking to us about.
Yeah, it's being launched this week, $17 billion LBO, $9 billion in financing. That's a big deal, and so the confidence.
How much of that is private credit?
So right now it's not clear. It looks like it's some of it's going to be in that market, but that's a big number, right?
So that's something you would take a look at.
Yeah, I think it's all about pricing and structure.
Right. Okay.
But the fact that a large deal like that's coming out is a big deal. I know one of your all-time favorite restaurant chains, Fogo de Chao, which is $1 billion deal also coming out. So what's happening now in the large cap market? They're starting to wake up now. The direct lending market, our business, has actually been active all year long. If you had said to me back in January, Randy, what do you think the year's going to be like? Just given all the static on rates and inflation, I would have said, boy, we'll be lucky to get to where we were last year. We are now at and perhaps even ahead in some of our businesses of last year, in part because of this flow going from public to private. So, and then I think, our scale now is growing. We have the ability to hold larger deals, and so the result of that is these sponsors, they keep coming back to us we liked what you did in the last deal, let's do it again. We negotiated all the documents, that was a pain in the neck, let's do just the same document and keep going. The other thing that's adding to the activity is these, and I mentioned this to you last time, the number of acquisitions that the platform businesses are doing in order to grow has significantly increased. So we just looked at the league tables for the quarter. We're the most active lender in direct lending right now for add-on acquisitions.
Churchill Asset Management.
Churchill Asset Management. And we're like the second largest for everything in the traditional direct lending business. So what's happening is our portfolio is actually generating deal flow. It's by just virtue of these are platform companies that are making acquisitions. My wife calls it shopping in your closet. So this is what's happening. The portfolio companies are actually generating deal flow. So we are having a bigger year than we thought. And then in our junior capital business, which is mezzanine debt, co-invest of equity, that team is having a significantly better year than last year because of the activity that the sponsors are looking for more equity to put into their deals, because who knows when their next fundraising is going to happen. They have limited capital, so they go to their LP relationships and say, hey, Churchill, how would you like to put in some money into this deal?
It's so interesting that this whole market, that you guys, but also the whole industry, is growing so quickly in the face of rising rates, right? Or is maybe because of rising rates. I was talking with Mark Lipschultz last week from Blue Owl, and he thinks that we're going to see a $10 billion private credit deal, shortly.
Correct. Yeah.
Which would be, now I think the biggest single direct lending deal is like $5 billion, which is already huge.
No question.
Is it because of rising rates that this industry is growing? I mean, why are the banks letting so much of this pie get away?
Yeah, so they've been letting it get away since 1993, right? Because they've been regulated, consolidated out of the leverage lending business, particularly in the middle market. So the deals that you're seeing now are very like corporate-y, double B, triple B, those kinds of things. For the direct lenders, what's happening is everything else is coming our way. All the middle market flow is coming our way. A lot of the sponsors who are trying to get quick executions in this market are trying to get this stuff done. Now, what's driving it? The investors who in a high rate environment are looking for yield right now are looking to private debt. That's what's actually fueling our activity, because the more money that we raise, the more fundraising that happens in our business allows us to scale our platform. The most interesting stat.
So there's just so many more lenders out there. It's not as much about the borrowers necessarily.
It's more the investors who are focusing on the leading lenders like Churchill to dedicate their money to. So there was a survey. I was at a conference last week on a panel. 62% of investors surveyed said they were underallocated private debt. That blew me away. Like, wait a minute. The three of us have been talking about private debt for a couple of years now, right? You think the message is out there, but because rates are higher, and now I can get a 12% yield on an unlevered senior debt investment, out of whether it's a Churchill or some of our other, providers out there, that's a really good number. And so when you compare that to what you can get in the bond market, what's happening is investors are saying, I need to do more, even though I'm maybe allocated right now to private debt, I need to do more. So I feel that's 2/3 of the market saying they're underallocated in this asset class, and we haven't really gotten going yet. I mean, there's still a lot of runway for us.
So are you guys raising money at the moment currently?
Yeah, we're always raising money.
Is that right?
So I'm headed to Scandinavia next week to meet with our clients and potential clients there. Going to Copenhagen, going to Stockholm, and I know your favorite, Helsinki.
Yep.
Never been to Helsinki, so let me know if you got some good restaurants. But when I'm
no, because it's Helsinki.
It's Helsinki. Yeah. Okay. Do you like fish? Yeah. So I was in the West Coast this week, and I'm telling you, very sophisticated institutional investors are saying, we'd like to talk to you about your platform because we think we need to explore more in the private debt space.
So who's your competition?
Well, it's funny. We don't really have competition. We have collaborators. We have partners that we lend with. So what happens is, since we're an investor in all of the funds with the sponsors that we're financing, we don't lose deals. They'll say, hey, even if, let's say, Blue Owl, perfect example, they say to Mark, hey, we want you to lead this one because, they tell us, Churchill, you led the last two, so we're going to give Mark one. They'll say to Mark, hey, would you please include Churchill in the deal because they're a significant LP investor in our fund? And Mark's saying, okay, fine, we'll give them a little piece. So that makes us sort of invaluable to the sponsors because they know that we're always investing in their funds. And frankly,
you're investing equity into their
funds. And it also makes it invaluable for the other lenders out there because they know they can always count on Churchill for a good transaction to split the deal with them, lead the deal with them. And we frankly, whether we lead or we co-lead with someone, all we really want to do is split the deal 50-50, be able to talk to the economics and terms of the transaction so we control the deal. But other than that, we have a lot of partners out there that we do business with, and we're very happy to do business with them.
All right, so you do a deal. How much do you sell off, and how much do you keep?
We just did a financing right now. It was $500 million hold that we're probably going to sell down to, I'm going to say, like $300 million, something like that.
So you'll still hold $300
Big chunk
of it?
Yeah.
Is that typical? Because at Chase Manhattan Bank, we'd sell down to $15 cents left.
That's why you're not in the business anymore, okay? But what's happening is we have mouths to feed too, right? We have all these investors, and so the more investors that we have, the more we want to spread that wealth out to. And so the more money we raise, now we're going to spread 400 around. Now we do 500. But if you have 40 funds that you're allocating across all 40 funds, the amount of that deal per fund is really small. We don't have any exposure over 2% of the whole portfolio.
What is the default rate? Because people look at these juicy yields and say, sure, I want to get in, but this is floating rate debt, right? So some of your deals previously would have been paying, I don't know, 6% interest, and now they're paying double that.
Right. So
that's got to be hard for some of the portfolio companies, right?
So because we've been through this before, we pre-model everything as if it's going to be at 12%. So we haven't had the kind of issues. Now the interest coverage has shrunk for sure. We did just a model the other day, and it looks like instead of 4 times coverage, we're like 2.5 times coverage because of that doubling of interest cost.
That's still good.
But the free cash flows of these companies and the growth of these businesses, I mentioned the add-ons, all of that is helping to grow those companies to accommodate the higher debt. But still, you've got every deal we do, we look at and we say, what's going to happen if rates continue to go up? What's going to happen if we go into a recession? The result is we do only like 5 deals of every 100 that come in the door. Think about that. So I'm turning down 95% of every deal that comes in the door. I mean, that's a tough commercial proposition, but the reason that we're successful,
because you're very picky.
We're very picky, but
you know the people you're lending money to. You're working hand in hand with them.
And we don't see 100 deals; we see 1,000 deals. So we do 50 new transactions, 150 add-ons, and with each deal, we're doing more and more per deal. So we'll still do $6 billion or so of volume this year in just senior lending.
Man, what a business!
I want to be in that business.
I know exactly.
What am I doing here?
Exactly. We get
Randy, I'm gonna pep up my resume and
Please
send it over.
Send it on.
All right, Randy, thanks so much for joining us. We always appreciate getting some of your time. Randy Schwimmer, he's co-head of senior lending and senior managing director at Churchill Asset Management, and more than anybody else, I think he schooled us.
Right. Well, he schools, I think, the industry because he also is the publisher of The Left Lead, which is one of the most popular places to get information on this industry.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
All right, let's switch gears to our C-suite check-in here today with Gina Drosos, CEO of Signet Jewelers. Signet Jewelers trades on New York Stock Exchange, SIG, based in Akron, Ohio. See, Matt, we got you another Ohio company.
I like
it.
So
good stuff. It's got a market cap of $3.4 billion. Stock's up about 12%.
And it's a very car-related town, right? Because isn't that where Goodyear? Yeah,
one of the tire things.
Yeah.
Gina, thanks so much for joining us here. Talk to us about your business here. What are the trends you're seeing so far this year, and what are you telling your shareholders about next year?
Yes, we're seeing some very interesting trends. In the second quarter, we were able to over-deliver our revenue and bottom line guide. And some of the strength that we saw was in lower priced fashion jewelry. So jewelry under $1,000, almost a back to school like trend, whether you go back to school or not. People often refresh their look at that time of year. And we saw strong sales. That bodes well for jewelry being in the consideration set as people move toward holiday. I think the other really big trend that we've seen is that there has been a lull in engagements. So this year, calendar year 23, engagements are down about 25% versus a typical pre-COVID year. That's a temporary COVID disruption. People usually get engaged 3.25 years after they meet. And 3 years ago, we were in lockdown. And so people were not meeting in the same way. So
that's romantic.
Yeah, exactly. So that trough of engagements is happening right now, but we expect it to begin to come back in our fourth quarter. And that provides a 3-year tailwind actually for us because about 50% of our business is in the bridal category.
So do you care about the Chinese and coming in and buying stuff, or is that really not your business, Chinese consumer, tourists coming into the States? Is that not really your business? Because I know for a lot of the folks here in New York City, they can't wait for the Chinese consumer to come back.
That's not really a big part of our business, so it's not a strong impact one way or the other. What is interesting, though, is that people tend to buy jewelry associated with travel. And one of the things that we talked a lot about on our second quarter earnings call is the proprietary data that we now understand about couples' relationship formation. So we have 45 milestones that we look at that happen from, we went to a movie all the way to we met the parents to we moved in together. And so we can track that. Going on a romantic trip together is one of those milestones. So for our business, it was actually good to see a lot of couples traveling together over the summer, attending a concert together. That kind of thing is good for future engagement ring sales.
How about, I think of class rings.
Yep.
I think of Super Bowl rings. I think of Signet rings. And I assume that's where you got your name. Are those things anywhere near as important as engagement rings to you?
Not as important, but it's part of the, customer's journey. I mean, what we try to do is meet customers at the point of market entry to the category, which is usually either getting your ears pierced or buying an engagement ring. And then we try to follow that customer and throughout their life through other milestones like birthdays or graduations or, anniversaries, things like that. So rings itself, fashion rings, are a big part of our business. Also, our K banner makes all of the NFL Hall of Fame rings. And our Zales banner makes all of the rings for historically black colleges and universities. And so we have a presence in those special kind of rings as well.
Gina, talk to us about the cost side of your business. What are the key drivers in your cost structure and kind of where are they moving these days?
Yeah, that's a great story for us. We've really developed a competitive advantage in sourcing. We are vertically integrated. We're one of only a small group of retailers who are site holders with De Beers. So we buy diamonds right from the mine. We own our own cutting and polishing facility in Botswana, in contract with several others in India. And so we have very good visibility into how the prices move of diamonds at different times. What that gives us is an ability to continuously offer customers a great value. And it also is part of our responsible sourcing strategy. We know that all of the gemstones and metals that we sell are sourced in an ethical way and completely conflict-free. That's something customers really care about. So I'm proud that our company can be a leader in that.
How about the cost of gold? Is that not that's what I think of. Of course, the diamond is, I guess, far more valuable than the gold ring that you put it in. But we have seen gold rise up. Right now, we're just under $1,930 a troy ounce.
Yes. So that does matter. What I would say is that while our product contains commodities like gold, like diamonds, it's not a commodity product. And so the retail pricing tends to have less fluctuation than the actual ingredient cost. And we tend to be able to price to cover that. Because, when people want a great look, with a gold necklace or a chain or whatever, they are willing to pay to get the high quality that we can provide them. The other thing that we do in a time like this is we bring innovations to the market. So one of the innovations that we have for holiday, the technical name of it is electroform, but think of it like putting gold around a straw, where we have a metal in the inside that we actually can chemically remove like a straw, and so then the gold is just formed around the outside. So you get a very big look for a lot less cost because there's less actual gold in the product. And so innovations like that, we work years out with our vendors to be able to uniquely offer to our customers so they can get a great value, no matter what the commodity price market looks like.
All right, Gina, thanks so much for joining us. Really appreciate getting some of your time. Gina Drosos, she is the CEO of Signet Jewelers that trades on the New York Stock Exchange.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Certainly one of the key stories we are following today is the strike by the UAW against the big three automakers. Ed Coury, he's an anchor and reporter for Bloomberg Radio. He is at the Detroit Auto Show, so we can get a little bit of a different view there from the floor. Ed, thanks so much for joining us here. What's the feeling there at the auto show about, day one of this strike?
It's kind of a mixed vibe. The people who are behind the show, promoting it, the people putting the displays together, the people working refreshments and so on, they know that their goal is to continue to push the future, the electric future of the auto industry, show off what's new and try to build some excitement. On the other hand, there is a lot of nervousness about the strike. How long will it last? Auto plants affected, which are very profitable for the automakers. So kind of a mixed bag of emotions here.
In terms of the political fallout, are they expecting, President Biden, who is reportedly going to come out and make a statement on this today, to get behind the unions as he is, as he proclaims himself the most pro-union president in the history of America? Or is he going to try and put a stop to this strike?
What we've been hearing from the president that he wants an agreement to be hammered out. He doesn't want the detrimental economic effects that we've all heard about to come to fruition. Now we're going to see some political action this evening here at Huntington Place in Detroit. There will be a charity preview for the auto show. They raise a ton of money for kids' charities in Detroit. Outside, just a block from here, the Bernie Sanders will be here with a bunch of UAW members. They will be demonstrating near the UAW Ford Center. So we're going to have that type of, again, mixed feelings about this evening and the strike. And I think it's safe to say that everyone involved wants a quick resolution. But right now, as you've been hearing, there doesn't seem to be one in sight, at least not in the near future.
So, Ed, is there any sense out there of how strong or how together, how cohesive the rank and file are behind this strike?
Oh, in Detroit, there have been union members speaking out, even at plants that are not affected yet by any type of walkout. As you know, selected plants have been picked for strike activity. But even those who are working today said they feel a little nervousness about this. They don't want a lengthy strike. But, the thing you hear over and over again from the rank and file here at Detroit and the area auto factories, they want to go back to where they were. They lost some ground. 2008 was rough. They don't like the fact that some workers doing the same job are making more than others. So they want that parity to be restored. And again, they would like to see a pay increase because they hear and read about the increases that the CEOs have been getting.
That's for sure. And, Ed, David Westin, Bloomberg Television, interviewed Mary Barra of GM earlier today. Boy, she came across, at least to me, as quite upset. I mean, I think she feels that General Motors has put a very credible deal on the table. And I kind of came away from that interview thinking, boy, I don't think the auto guys are going to be, the companies are going to be budging much, at least in the near term.
Well, you might expect that kind of stance maybe, in the initial phase of this strike. The automakers are, trying to maintain the position that they've had, that we came through tough economic times, that there is a bright future ahead. And you heard Mary Barra say that her salary is based on the performance of the company. And the company has earned money, and then just part of her contract, she gets increases too. But the rank and file, the union members say, hey, look, we are a huge part of the success that the company has had. Models are coming in, as new models are coming on the scene, and as we head into an electric future, they want to make sure that they're not going to be behind. They at least want to recoup some of what they believe they've lost. over the last few years.
Ed, you've been at the auto show for a couple of days now. I used to go every single year. It was like the biggest event on my calendar. And it has dwindled, right? I mean, back in the day, everybody was at the Detroit Auto Show. It was the most important one for the industry. What's it like this year? And have you seen anything cool?
Well, the good news is it is bigger than last year. Of course, there was, the pandemic when we didn't see any activity. And so, yeah, it is bigger than last year. No, it's not up to pre-pandemic levels, but there's a lot of excitement at the show. I mean, sure, you have the prototypes, the whiz-bang models that may or may not go into production 10 years from now. But models that you can buy, in the very near future are pretty hot here. I mean, Ford is out with a new F-150. There is a Jeep that's coming out, and it's attracting a lot of excitement. And also the Cadillac CT5 has a new look this year, and that's been a very, very popular model. So those big three Detroit automakers with a strong showing of something, people can really check out, and then, put a deposit on or go, order from the automaker too. So there still is some excitement here.
Ed, thanks so much for joining us. Appreciate getting it firsthand and reporting from you. Ed Coury, anchor and reporter for Bloomberg Radio in the great city of Detroit.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I've been looking forward all day to this. We have somewhat of a Wall Street legend joining us right now. Todd Harrison is founding partner and chief investment officer at CB1 Capital Management, but he has spent decades on Wall Street working for the big banks, including Morgan Stanley. He founded a company that I think a lot of us loved very much, Minionville Media, back in the day, which won Emmy Awards. And as I said, he founded the Ruby Peck Foundation for Children's Education, which is an important charity that I think a lot of people on Wall Street like to support as well. Todd, first of all, great to see you. Thanks so much for joining us. Tell us what you're doing now at CB1 Capital Management. What's that business?
I mean, we've been involved in the cannabis space for over a decade now. I actually just uncovered an interview that we did about 10 years ago talking about how cannabis was going to be my single best investment idea for the next decade. And that was actually 9 years ago. And it hasn't been. But recently there's been some news that we think is going to change the space and change the fortunes and really move this in a better direction. But CB1 Capital, we have an investment arm, we have an advisory arm, and we have an advocacy arm where we help Weldon Angeles and Mission Green to get people out of prison for this plant. So it's pretty comprehensive.
It surprises me that pot stocks haven't done better considering the uptake of the product. I think right now 23 states have legalized recreational marijuana, and you only have to walk around New York City for a few minutes to understand that people are consuming cannabis. Is there a disconnect between the sales, the outlook, and the performance of the stocks?
Certainly. I think it's one of the biggest asymmetric opportunities right now, right here, that I've seen in my 34 years on Wall Street. And why now is very much because of how we got here, right? So because cannabis has been a Schedule I narcotic for so long, and we won't go into that rabbit hole of why. But because of that, the big takeaway is that U.S. cannabis companies can't deduct normal operating expenses. It's called Section 280E of the tax code. So they're being taxed at an effective rate right now of 75 to 80%, and they have been for years, which is why only the best have been able to survive. And the industry was up until 2 weeks ago, really, looking at an extinction event because of the regulatory construct. But as you probably know, the HHS came out 2 weeks ago on Wednesday. It was the last couple of days of summer. I was here, but not many people were. They recommended cannabis go to a Schedule III, which would importantly remove that 280E tax code. And now we're just waiting on the DEA to codify that opinion. We think that could happen by year end, and then Biden can sign it into law before next year's election. That's just one thing that's happening. Safe banking, we heard last night. It was news broke last night, and it's moving around today or getting out today. That safe banking is going to go through a Senate committee markup. This is the sign or the tell that the Senate's going to pass safe banking for the first time, the upper chamber, and then conceivably be tacked onto a must-pass bill by year end. So there's a few things, right? And if they all happen, this could get really spicy. But just on the math alone, without anything else, if we move to a Schedule III, if that gets codified, you're talking about a 2 to 3x turn on some of these names just on math.
So explain to us why it's developed this way. 10 years ago, you thought it would be a much better proposition than it has been. What have been the big missteps? What has the industry missed? What has Washington missed over the last decade?
It's interesting. We spent a lot of time in Washington, and they had explained to us that the states are designed to be nimble and the federal government's designed to move slow, and then added, but the thing about the federal government is that when change happens, it tends to happen all at once. But because of the disconnect between state and federal laws, because the politicians have been very slow on the uptake, because cannabis is a complex issue with a lot of stakeholders that have a legitimate claim to participate in the industry, it's really become muddled down in a lot of different cross currents as the illicit markets really proliferated. So, as this comes online and becomes a legal framework, which we just took, again, a seismic shift 2 weeks ago for the first time after a 2.5-year bear market. This is the first domino, and it's a big one. And if the others fall, it can get spicy. But we need this to sort of relax the arbitrage between federal and state law, allow these companies to operate on an even playing field. And after what they've just been through, I would argue that they're pretty lean and mean and ready to go to work.
Todd, if I look across the market, there are a lot of different participants, right? Not just in North America, but mainly, right, in the U.S. and Canada. Are there companies you think that really have got it right? Are there companies you think that are solid, investable, that we should be looking at more closely? And can you tell me some names?
Yeah, of course. And I say this, we have positions, we advise some of these companies, but we got to know a lot of companies very well. Iron sharpens iron during a 2.5-year bear market. This was a 91% drawdown for MSOS, which is the ETF that we advise. But certainly you can learn a lot just by watching how some of these companies did during that trough, as we think it is in front of all these states onboarding on the East Coast. And you look at the Veranos, the TerrAscends, the Green Thumbs, and there's others, right? Glass House in California. As 280E goes away, as the federal government starts to move out of the way, it has to be incremental, the change. And that change, because it's incremental, like we don't have the political wherewithal capacity to move this to a deschedule where it should be, but Schedule III is a stepping stone to descheduling, happens to play right into the MSOs and the publicly traded companies' hands because they still have some of the protections and the barriers to entry and a very regulated market at the state level. But the federal government's moving to really support the 10th Amendment and let the states become the laboratories of democracy and those industries evolve at the state level as the federal framework takes shape. So this is a big, big catalyst. I don't think people really understand it. What's interesting, is that there is a pretty significant structural short in these names, we feel, because of, without getting too far into the weeds, because the U.S. cannabis companies have to list on the Canadian Stock Exchange. They can't list on U.S. stock exchanges, but the MSOS ETF is on the New York Stock Exchange. There's been a pretty pernicious algorithm that's been hitting these stocks down, naked short, we believe, naked shorting these stocks, routing them through Europe, however it may be. But we think they're still there. We think they're still trapped, and we'll see, how that plays out over the time to come. But the other interesting part is all the institutions, and we talked to a lot of these guys. We made a lot of calls after this news, and even the institutions or the funds or the family offices that can buy U.S. cannabis are telling us, a lot of them are telling us, after so many disappointments, we want to actually see it happen. We want to see this play through. We want to see it get done before we're going to believe it. And I think that's incredibly bullish also.
Todd, given all that background, what types of investments are you making in the space today?
I mean, we mentioned some of them. There's only a handful. There's really only so many tradable names in this space.
But your top, the top holdings in MSOS are Green Thumb, Curaleaf, Verano, TrueLeaf, Cresco. So that's.
Is there anything in the private space you're looking at?
Sure. I mean, just to talk about MSOS, the way that portfolio is constructed is that FANG on one side that, if you look at Y2K as sort of a preamble of what we're going through, everything they said technology was going to be happened, but not before the tech crash. I think cannabis is at that spot right now. But I think that, the FANG, if you will, those 5 names on one side, and then forgotten, as we say, some of these lower tiered MSOs on the other side, I think are having more beta, because a lot of them were trading at their cash levels a couple of weeks ago because there was no visibility on how they were going to service their debt, on what their cash generation levers were going to be, and that's starting to come into view right now. So both of I think that portfolio is well positioned, MSOS, and again, we're involved. But on the private side, yes, the capital markets have been shut down for a number of years. And I think that, not only for the stocks, but for the research and for the sentiment, this will help close the chasm between the state and the federal sort of discrepancies.
Do you have a view on what the heck has gone wrong in New York State? I mean, it is an absolute mess, right? There's only a few licensed dispensaries here. They only sell a select number of products. The best stuff that everybody wants, the Kana and the Camino products are only in like Empire and then, the million other shops around town that aren't licensed. How did they do such a bad job in New York?
Well, you sound like a consumer, my man. I mean, you just rattled off a couple of brands right there that this is not your first rodeo, I could tell. But New York, I mean, it's a cautionary tale. And listen, well-intentioned, right? I mean, they tried to do the right thing. But what happened was when COVID hit, and again, follow the money. The reason this was coming online in all these states was because the tax revenues are ridiculous, the job creations are ridiculous, and oh, by the way, it's good for you, like as we're finding out more and more. But when COVID hit and the federal government just completely, flushed all these budgets with cash, New York in particular said, we're going to create this framework that we think is just and rights the wrongs of the war on drugs. And like I said, well-intentioned, but anybody that's been around the block a few times knows that you can't legislate wealth, right? And there's a big difference between criminal justice, people shouldn't be in prison for a plant, and social justice, right? They necessarily shouldn't be at the front of the line either. And I think that there's a balance there, and there's we can do this together. I believe that, but New York never really allowed the opportunity. Maryland did it right. Missouri did it right. They levered the medical industry into an adult use industry, and then when they made money, they sort of addressed the social justice issues. New York tried to do that the opposite way. Now you walk down, there's 14,000, 14,000 shops in New York. Most New Yorkers think that's the legal framework, but that's going to transition, right? So it's a process.
I hope so.
Over time, prices will come down. The illicit market will get crowded out. Besides, they're selling pesticides and emulsification agents that are literally poison. So that'll go away, like bathtub gin once went away.
Dude, imagine if you could only buy Brooklyn Lager.
Yep.
You want a Lagunitas or you want a Sierra Nevada, and they're telling you can't get that at a legal shop.
The social injustice of it all. Todd Harrison, thank you so much for joining us, founding partner and CIO at CB1 Capital Management.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get to what I'm driving this week.
Yeah, what are you driving?
I just a disclaimer that the car makers allow me to use these cars to test drive. I've been covering the industry for 20 years now, and so I often get a new car or a truck or a motorcycle to test out. This week, I have something special, and so the purpose of this hit is twofold. Number one, I want to tell our viewers about a product. And number two, I'm trying to convince you to get one of these cars. I'm bringing my buddy Matt Hardigree to help me do that. He was the editor-in-chief of Jalopnik. He's now working on a site called Autopia, but he's been also in the industry for a couple of decades here covering cars. Matt, you know, it's long been the dream of, I think, every auto journalist to get an absolute stripper of a 911. That is to order the base model with no options at all. And I have almost achieved that in this test ride. It's a Carrera T, which is like already the stripped down version of the 911. It only has the essentials, the things you need, like a short throw shifter. And it has almost no options on it. I absolutely love it. With one exception, and that is the color.
I love the color. You look great in it.
I don't know, Matt, you probably can't see it, but maybe you've seen, the color is called Ruby Star Neo. It's like a purple pink, like a Barbie pink.
I mean, it's the best color. You got the best color, and you're complaining about it.
My daughter thinks so as well, but give me your thoughts first off on the Carrera T, the 911 Carrera T.
It's great. I mean, I think what Porsche has done is realized that as with a lot of things in life, the more options, the better, and the more money they can get. And, you know, for an enthusiast, I am not likely to buy a 911 Turbo. It's a little pricey, but if I'm in a 911 range, they have created something that fits between the true base Carrera and the Carrera S, and they call it the Carrera T. And somehow, by creating a cheaper version of the Carrera S, they've made it more desirable than a Carrera S. They are selling at pretty high levels for people I've spoken to. And the problem is, even though it's the stripper version, it's a little bit faster than the base Carrera. I did one myself. I built one before the show, and I was like, oh, you know, it starts at 130. That's such a great price. I'm only going to add a couple of options. And you get on the Porsche personalization page, and you're like, well, I need Hardigree yellow seat belts. I definitely need to have the special brown. I like it in brown, the special brown color. I need this. I need that. And then all of a sudden, it's you're $140,000 into a car. So it's genius. I think it's genius. You got it with the manual. Who cares what color it is? As long as it has a manual, that is the right car to get.
Well, and that's the beauty of this. So the base model Carrera, the absolute cheapest one you could get, doesn't have the manual as an option. You have to get the PDK.
Oh, please.
Which is a very amazing automatic transmission, but it's still an automatic transmission. And Matt, the benefit the T has over the Carrera S, I was talking with Luke Van de Zandy, who runs PR for the 911 at Porsche in the U.S., he told me you can't get the short throw shifter on the S. You have to go up a level to the GTS to get that. And that, to me, has been the revelation with this car. You know, I had a Carrera S, a 991 Carrera S.
Sure.
And I had never thought about changing out the stick. This little stick is so much better than the big stick. I don't like a big stick. I like a little stick.
Who does?
You know? The other revelation for me with this car is the cloth seats are amazing. I've never preferred cloth over leather. And these are just, I'd rather have them. So I feel like it's an opportunity for Paul Sweeney to get a new car and save a little bit of money because he's not buying the Turbo S.
100%. It's a great deal, Paul.
All right.
I think you would be silly not to buy it at this point.
Hey, Matt, how about you like Matt are a car guy, and you're at the high end here. I can't imagine the Ferraris, the Lamborghinis, the Porsches of the world, they're going electric willingly. Are they scratching and clawing to remain in the ICE world?
No. If you look at, especially in Germany, there's been a big push with the EU regulations coming up. Theoretically, that in a decade, we're going to have essentially no gas-powered cars. To get that legislation through Brussels, basically the Germans said, specifically Porsche and Volkswagen said, you know what, e-fuels, give us an exception for carbon neutral e-fuels, because no matter what, even if they build electric cars, even if they sell primarily electric cars, no one I've talked to at Ferrari, no one I've talked to at Porsche has given up on a gas-powered car, because for a sports car, even though an electric car might be faster, nothing just sounds, and I love driving electric sports cars, nothing sounds right. You don't get that feel of a short throw shifter. Like you need that visceral reaction, because that's what you're paying for. You're not paying to get somewhere faster. You're paying to get somewhere with more excitement, with more joy.
That's this car definitely fits that bill. I mean, it isn't the fastest car on the road. It doesn't feel as quick as my Carrera S, and it doesn't have as much horsepower. It's 379 horsepower. My Carrera had, I think, 400, and now the Carrera S has probably 430. But it's got that build-up. It's got that, the gradual acceleration, and the sound from the sport exhaust is just amazing that I absolutely love. Plus, it only weighs like 3,100 pounds. So that's incredibly light. By the way, maybe you can help Paul out with his conundrum. Veering away from the 911 for a moment, he has the last manual 5 Series. He has the 2014 535i with a stick. And now he's worried that it's going to start getting old and he's going to have to make repairs. Should he get something else, or should he just make the repairs and keep the car that he loves the most?
He should get rid of it and give it to me, because I have a 2003 5 Series 530i with the 5-speed. And it has 235,000 miles on it.
235,000 miles.
235. Look, it's 2014. It's a little sketchy. You're on the edge where the car is so modern that sometimes fixing things becomes cost prohibitive.
Yep.
But you're just on the right side of the edge. I think you can make this car last, and it's not like mine. Mine is like Legos. You can pop something out, you can pop something in, and you can generally fix the car. Your car isn't Legos. Unfortunately, it's Lego Technic. It's a little bit more advanced, but no, you're never going to find, this is the problem. You're never going to find something new that feels as good as that car, because they can't make cars like that anymore. So either put it on Bring a Trailer and regret it for the rest of your life, or spend $2,000 or $3,000 a year with your mechanic getting it. I think that's the best move. Got to keep the car, or give it to me. Also an option.
Give it to me. Exactly, that could be an option. All right, Matt, thanks so much for joining us. Lots for me to think about over the weekend. Matt Hardigree, he's a publisher of the Autopian. And talking cars with Matt Miller. Matt Miller driving the Barbie pink Porsche Carrera T.
Love it. I have to give it back, unfortunately. I only had it for a week. But I joined the Autopian. Oh. So I get that membership, I think, for a whole year. And plus they're going to send me like a velvet T-shirt.
Oh, cool. Very good. And I'll tell you, the Bloomberg Courtyard is a great place to kind of showcase cars. It looks cool.
Yeah.
I mean, you could rent that out, maybe make a couple of bucks, whoever owns this place.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.